You are listening to The Vocal Technologist. Spoken tech for your ears.
Welcome to Vocal Technologist. It's Web3 Wednesday, and yeah, we've got quite a bit happening in the crypto world to unpack today.
We certainly do. Our aim here is really to cut through all the noise, pull out the key bits of knowledge so you get a clear picture without feeling totally overwhelmed.
Exactly. Okay, let's dive in. First up, some interesting moves on the regulatory front, which seems linked to, how institutions are feeling. The U.S. Fed just ended its novel activities supervision program for crypto banks. What's really going on there?
Well, what's fascinating is the Fed isn't just dropping oversight. They're actually taking what they learned and rolling it into their standard processes.
Standard processes. So what does that mean practically?
It means they're getting rid of that specific separate guidance. It signals more of a normalization, you could say, rather than just easing up completely. They're starting to see crypto banking as, well, less novel and more just part of the financial system that needs, updated rules.
Okay, so less of a special crypto sandbox, more like bringing it into the main regulatory house. That sounds kind of positive, but couldn't making it standard actually mean a sneakier kind of control maybe? Not really easing.
That's a really good point. It could, but it also brings clarity, right? And maybe more predictable rules, which, frankly, institutions really want.
True, predictability helps.
And speaking of big institutions, look at Norway's sovereign wealth fund. Huge player, the world's biggest. In Q2, they seriously upped their Bitcoin-linked holdings.
Oh, yeah. How much?
An 83% increase. They went from holding about 6,200 Bitcoin indirectly, mostly via MicroStrategy, to 11,400.
Wow, 83%. That's a statement from a player that size.
Right.
What's the signal you read from that?
It points to this quiet, almost strategic shift happening with sovereign funds. It's not just about liking Bitcoin. It suggests they might be de-risking their traditional portfolios against, say, fiat instability.
So using Bitcoin, even indirectly like this, is kind of a hedge. An emerging reserve asset, maybe?
Potentially, yeah.
Yeah.
It looks like a hedge, and it's definitely a very public one.
That is a powerful signal. Okay, all right, let's switch over to the real cutting-edge stuff in DeFi. Financial engineering is getting pretty wild. We're hearing about things like tokenized delta-neutral strategies, hyperliquid, unit liminal. What on earth are those?
Yeah, Disney sounds complicated. But basically, these platforms are trying to make complex yield strategies simpler. They've got these things called xTokens.
xTokens.
Right. They represent pooled positions. So the pool buys the actual crypto, that's the long spot part, and at the same time, it shorts perpetual futures contracts, or perps.
Okay, long spot, short perps. Why do both?
Well, the goal is to capture what are called funding payments. These are small fees that pass between the long and short traders in the futures market to keep prices stable. And by doing both long and short, they try to stay delta neutral.
Meaning they don't care if the price goes up or down, they just collect the fees.
That's the idea, yeah. Immune to price swings, just earning the yield from those funding payments. And the X token makes this whole complex thing portable, usable across different DeFi platforms.
Okay, I see. That sounds clever, making complex yield easy to move around. But what are the risks here? If everyone starts using these without fully getting it, could that create some hidden instability?
That is the crucial question, absolutely. It boosts capital efficiency, makes things more composable, which is great for DeFi. But yeah, if it gets too big too fast without real transparency or solid audits, you could centralize risk without realizing it.
Right. Powerful tools need careful handling.
Exactly. It's still leverage, just packaged differently.
And speaking of leverage, the whole market seemed to scream risk on in Q2. Crypto leverage just surged, didn't it? What was driving that?
Oh, massively. DeFi lending hit a new all-time high. We're talking $26.47 billion. That's up over 42% in just one quarter. Yeah. And CeFi lending grew too, plus futures open interest went way up. It's not just retail this time. Rising prices helped. But there was serious demand from digital asset treasuries.
What are the warning signs, though? Anything worrying in that data?
Well, ETH borrowing rates actually spiked higher than staking yields for a bit. And the Q to unstake Ethereum hit a record 13 days. That tells you demand to borrow ETH was intense. Total leverage is getting close to early 2022 levels.
Okay, so market's hot again. Risk appetite is definitely back.
Seems like it.
So while we've got this advanced financial stuff happening and market heat returning, what about just getting crypto into the mainstream? We saw Gemini filed for an IPO on Nasdaq. It seems pretty bold given they reported a net loss for the first half of the year.
It is bold, definitely. But think about it. If they succeed, they become only the third U.S.-listed crypto exchange. That's huge for visibility, for legitimacy.
Good point.
And yeah, despite the loss, look at their moves. Shifting users to that Florida entity, Moonbase, getting that $75 million credit line from Ripple. It shows they're adapting to the regulatory scene and really pushing for wider acceptance. It's about making crypto feel, I guess, more normal for traditional finance.
It really feels like the whole infrastructure layer is maturing fast, doesn't it? Making crypto sort of invisible almost, like crypto debit cards that markets expected to hit $9 billion by 2034, apparently. Just swipe and spend your crypto.
Exactly. Seamless spending. And that push for invisible infrastructure leads to this idea some are calling an AWS moment for payments.
Okay, AWS Moment for payments. What does that mean for you, the user?
This is where things could get really transformative. You've got companies like Circle with their Arc platform, maybe Stripe with something called Tempo. They're building what you might call payment native chains.
Payment native chains, like blockchains just for payments.
Sort of, yeah. Think about how Amazon Web Services, AWS, made cloud computing infrastructure just available, a commodity. These chains aim to do that for payments. They might use stablecoins like USDC as the fee you pay for transactions.
Oh, interesting. So you wouldn't need some separate network token just to send USDC.
Potentially, yes. And they're being built for high speed, high throughput, perfect for things like AI needing to make tons of tiny payments or big companies finally jumping in.
So basically, they're building the plumbing to make traditional finance work smoothly with DeFi, creating this efficient, maybe compliant backbone for pretty much all future digital money movement, whether you notice it or not.
That's exactly it. You're watching the scaffolding go up for a whole new era of digital finance. It makes your digital assets potentially much more useful, more integrated into everything.
This has been a real whirlwind through Web3 today here on Vocal Technologists. Lots happening. So as we wrap up, here's something to think about. If this payment infrastructure becomes as everyday and invisible as something like AWS, and at the same time, institutional leverage and risk appetite are climbing back up, how might this invisible crypto change not just how you handle your money day to day, but maybe the whole shape of money and banking for you over the next decade?
Spoken Tech for your ears.